Well, hello there. Welcome back to Information About Module 2. This is Professor West, and with me, as always, is my colleague and good friend.
Professor Valentine, howdy.
And, oh, I'm glad you're here with us because between the two of us, we do believe we know most of this material.
Most of it, we will make mistakes. And when we do, two things: don't laugh at us too hard. And number two, you know that we're human too.
Yeah, make sure you're on mute. All right, so with that, you've seen this information before. Hopefully you've looked at our intro video. These are the items that we set up as your key takeaways. And you've got to know these, before you walk into an exam. Those are the key things. You know we're going to test them. You got to be ready for them, okay? So that tends to be where your focus is. And we're going to back all of that up by taking you through some problems and how to see all of those things come to life in problem calculations. The next thing that we talk about, and we went through this briefly in the PowerPoint slides, and this idea of why do we worry about what we call these different costs, okay? And so one of the reasons is if you're talking to somebody in an organization, you want to make sure you're talking about the same thing. So we need to have a common purpose, what we're trying to accomplish. And then we also, to get that done, we need to make sure we have a common language. And so one of the things that students often have trouble with is this idea, or they'll point out, well, that exam was nothing like what the professor talked about in class. Well, the common purpose is the idea that you're trying to get a grade, we're trying to assign a grade, we're trying to get you to learn material. Boom, that's a common purpose. Problem is, you might not see the common language. And so one of the things Eric and I are trying to do in every module is make sure you understand those basics and make sure we're talking in the same language. So that's the way we're trying to set this thing up.
You know, a lot of students, a lot of people you'll meet when you tell them that you're taking accounting or you're an accounting major or something like that, they'll say, oh, accounting, it's just too much math. It's too much math. Accounting is much more like French than it is like algebra. I mean, it's the language that really hangs a lot of people up. So if we get this language thing down, you can do everything.
Yeah, and one other thing, make sure you don't call either one of us a bean counter.
Yes.
That one is a pet peeve. So just a heads up. Okay, so then one of the things we also talked about in our setup PowerPoint video was the idea that you have to think about information as whether or not it's relevant to a decision. So we're following along what Eric just said. Is it relevant to a decision? And the accountants like to use a fancy word, faithful representation. And ultimately, that goes back to the idea, is it reliable information? And so are you more likely to trust the information if it's coming off of an obscure internet website, or are you more likely to trust it if it's coming from certainly a more reputable source? So trying to decide what information is reliable is key, and often is traded off based on relevance. So if you think about your introductory financial class, they were all about reliable. What we tend to be about here is about relevance, because as Eric said, it tends to be about this issue of does it affect my decision making? So that's the challenge. Any of these others, these little boxes that are kind of the underlying factors that drive relevance and reliability, any of those stick out for you, Eric?
Well, the predictive value and the confirming value of the relevance, those are important, you know, because that's the crux of it being relevant rather. If it doesn't provide you any information for you to make any decision, has no predictive value, how relevant is it? You know, and if it's good information, you know, the feedback value, can it be, you know, replicated consistently, is is the information going to be good and pure every time? That's very important.
Yeah, the other thing about these, I think, and when you talked about those terms, interesting, you would pick those two out because those are really the essence that people are looking at when they start talking about data analytics and big data, because everything around those kinds of modeling situations are about predicting and confirming something that's happened. And so that kind of clarity is trying to make sure that you focus on the information that's relevant to that decision. Over here, the reliable part, the one that always gets me focused on is this idea: does it have errors in it?
Mm-hmm.
And how much?
Right.
You know, if there are a few, we can live with that. If perhaps, depending. I mean, if you're doing surgery, I'm not sure you can live with a whole lot of error. But the other thing that's important is it's neutral. It
Yes.
presents the situation without a bias one way or the other. And so that's one of the things we're always trying to look at in terms of whether the information is reliable. And you're going to find out that throughout our discussion that accounting is just full of assumptions. And
Yes.
one of the things we're going to really keep after you all semester is the idea of identifying the assumption, finding out whether or not it's a reliable assumption, and to what extent it influences the decision that you make. So while you might have thought intro financial was more rule-based, this one it has rules, but there's a lot of judgment. And so that tends to drive students a little crazy from time to time because they want just an answer. Sometimes there are multiple answers. You see that in the students you've taught over time, Eric?
Oh yeah, absolutely. And one of the issues that comes up sometimes on assignments and exams is when you have a write out problem, we want to see the problem written out oftentimes because we want to know your logic and your assumptions, because you can come up with the right answer, and if it doesn't hold in every situation, under every condition, it's wrong. Even though you have the right number, but if your process is not valid, it's the wrong answer.
Yeah, so if the answer is 4,200 and you just happen to write 4,200 just because we can't follow the process, that's not going to get you anywhere. So
Right.
this learning is about a process. You'll hear us talk about that all the time. Follow the process. And so that's what we're trying to see. And if we can follow the process, then we're also in a situation you might be able to start collecting some partial credit or those kinds of things if you do happen to make a mistake. Because as Eric said to start with, we might make a few ourselves. So cost terminology, at this point, we want to come back to some of the discussion we had in our PowerPoint introduction. And so one of the things you have in your handout is this thing called a cost classification matrix. And there's a couple of pieces of this that are important. One is we've got product costs and period costs down the side, but we've also been able to classify the same costs in a different way as whether they're variable or fixed. And so I could have something that's called a period cost, but it also could be a variable cost. And so both of those things can be true. It just depends on how you want to classify it and think about it. So Eric, why don't you take us through some of these items and let's get them some basic definitions here in the way we set up our cost classification matrix.
Okay.
Where do you want to start?
Let's start with the product cost.
Oh, okay. Some of our
So,
favorites.
yep. So our product cost, we have our materials, labor, and overhead. There are really only three product costs: materials, labor, and overhead. You'll see that like throughout the semester.
So
That,
you'll hear us both, certainly me, because I get stuck on these things. I talk about the three product costs as dumb, dull, mo. All right.
yeah.
Those are my three. I call them my product cost stooges. There's dumb, dull, mo, and this is what you can sing to yourself: dumb, domo. And so remember that, that how offensive that was. And at that point, you should know it, so I don't sing it again. So direct material, direct labor, and
Please
manufacturing,
memorize that.
please. Yeah. And so manufacturing overhead. Now, Eric, though, has just pointed out, I've got overhead in both places. So tell me a little bit about that, Eric.
Well, yeah. So we have variable overhead. Again, we talked last time that a variable cost is a cost that moves directly with activity. So as our overhead, as our activity changes, our variable costs will change. So that includes our variable manufacturing overhead. Our fixed manufacturing overhead, or fixed overhead, that's like the rent on your facilities or your depreciation. Regardless of the volume, that does not change. It's still overhead, but that's the fixed portion that's not going to change relative to activity. The variable overhead will change relative to activity. So let's compress this a little bit to define what is manufacturing overhead. Again, we said there are only 3 product costs. There's direct materials, direct labor, and manufacturing overhead. Direct
Is it time for me to sing again?
No, please.
Okay, all right.
All right. I'll let you go. Yeah, you can sing
Okay,
solo.
let me know. Let me know.
Sing solo that we can't hear you. So the direct material is labor. I'm sorry, direct labor are your wages, your employees that have an hourly wage, who directly touch the product, the assembly line, sort of people on the front lines. Direct material are those primary materials that go into the finished product. That could be wood, that could be gallons of chemical, what have you.
Oh,
Manufacturing over.
Can you see my Yeti cup?
I do now. Yes.
Okay, so what's the direct material in that?
That would be
Steel?
aluminum.
Oh, it's aluminum. I don't know. Lead?
Yeah.
I got nothing.
Right.
So,
Yeah.
all right. So that's the material part.
Yes.
So you've set them up.
Yeah, and the manufacturing overhead there, you can find plenty esoteric definitions of what manufacturing overhead is. But here's what manufacturing overhead is. It is the product cost that are not direct material, direct labor. Any manufacturing cost that's not direct material, direct labor is manufacturing overhead. So rather than trying to memorize a list of things, if it's a manufacturing or product cost and it's not direct material, not direct labor, it's manufacturing overhead.
Yeah. And you'll also hear us talk about this idea, if it has to do with the factory, it has to do with production, and it's not material or direct material and direct labor, it's overhead by default.
Yep.
So those are the pieces you need to keep in mind.
Those are the words those are your key words: factory, plant, production, manufacturing. If you see those in the definition, you know that's going to be manufacturing overhead.
Yeah. Okay, cool. And that's a pro tip right there. So make sure you write that down. All right. Tell us a little bit about these period costs.
So period costs are those costs that are not manufacturing. And so they are.
Now hold on there just a second, because you've done it again.
Okay.
You said, okay, here's this, and if it's not that, it's this other thing.
Yes.
And so just like you did with the product cost or direct material, direct labor, if it's not those and it has to do with the factory, overhead. In this case, if it's not dumb, dull, mo, it has to be a period cost. And so he's setting you up with these key comparisons to make sure you know how these definitions are working. So make sure you're following that direction, because that'll help you a lot. Okay,
right.
Go ahead.
So if it's not manufacturing, then it is a period cost, and that only means that it goes to the income statement as soon as you incur it. The period in which it's occurred, it goes to the income statement. And so now, as far as the variable versus fixed portion, the behavior doesn't drive the cost classification. So they can, just like we saw, we have variable and fixed manufacturing overhead. You can have variable period costs and fixed period costs. So
so you're saying that over on this dimension, we've got the classifications. And over here, we've got the behavior
Yes, exactly.
and how it acts. So we've got those two pieces, two axes, if you will, and that he's able to classify these items based on the behavior, even though they're both period costs.
Exactly.
Okay,
Exactly.
so tell
Yeah.
us a little bit about commissions and salaries.
Yeah. So commissions are, based on your volume of sales. So because it's based on an activity, and the more the greater the activity, the greater the cost. That's going to be variable. That's going to be your variable cost.
So
Your
if you think
sale.
about this, if
Sorry.
you think about this as a realtor, and their house, they get a commission on everything that they sell. So the more houses they sell, the more commissions they're going to be. So that kind of idea is what we have here. So this idea of selling more at a retail store, if there still are retail stores,
Yeah.
and so you could get paid a certain amount just because you sold an item. The alternative is going to be the
That.
salaries, right?
Yep. Exactly. Exactly. So that's more. I was going to say more administrative. It's not exclusive to administration, but the point is that it has no variability based on production, based on productivity.
Yeah.
So if you're getting paid a salary, salary implies that you are set or you are paid a set amount, regardless of your productivity. So if you see commission or wages generally, that's going to be variable. Generally speaking, salaries is going to be fixed. So it's a monthly salary, hourly wage. So the more hours you work, the more money you make. Monthly salary, regardless of the hours you work, this is how much you're going to get.
So there's a couple of loaded words that everybody needs to pay attention to because they're things that give you an idea of the behavior of that particular cost. Okay, is that fair?
It is. It is.
All right. So the next thing we want to do is put this into action a little bit. So we're going to work this problem. Now to do that, we're actually going to come over here and put this into our spreadsheet, take a look at it. Oh, before we do this one of the things to remind you is these spreadsheets are available to you in two ways. One, you can get it as an Excel spreadsheet, or alternatively, you can get it as a PDF. Same thing. Some people would rather do the annotations on the PDF. Some people would rather do them in Excel. We'll actually use the Excel items in here, but we tried to make it available to you in any form that you wanted. Okay, so let's take a look at this example. And what we've tried to do here is the same thing Eric just asked you to do, which is to say, can I classify these things in multiple ways? So initially, we're looking at things that are variable costs and asking you to define whether or not they're product costs or period costs. Okay, so we'll go down through like maybe the first two or three of each of these. Then we'll let you work on the final two or three, and then you'll also be able to get the subsequent answers from us when we post a completed sheet as well. So, oh, there's a couple of magic terms right away, Eric. So you got direct material and direct labor. They're going to be variable, just as you pointed out. Okay.
Yep.
And so are they always going to be product costs or period costs?
Those are always going to be product costs.
Okay.
Your direct costs are always going to be your product costs.
That was another key phrase he just gave you. If it's a direct product cost, it's always variable cost. Write that down. That's a rule of nature. Okay. Probably was in your physics class as well. Okay, then I got this sales commission. That clearly is going to be a product cost, right?
Absolutely not.
Oh,
It is, it is sales. So it is done after the production process, after the manufacturing. So that's going to be a period cost.
so you're telling me that once a product is made, so I've completed my product, anything that happens after that is a period cost.
Exactly. Yes.
Okay. So once a product is finished, every cost that occurs after that, no matter what it sounds like, no matter how it's phrased, if it's after the product is completed, it's a period cost.
It
Okay,
is.
got it. And then
It
there's
is.
the ever popular variable overhead. I think we can all agree that goes here. And you've got a couple that are kind of interesting. So hourly pay, Eric already set you up for this to kind of give you a sense when you see those terms, you know you're working with variable. And here I've got a human resources clerk, somebody who handles the hiring, the firing, those kinds of things. So are they going to be a product cost or a period cost, Eric?
I would say period.
Yeah,
Because
I think that's probably right.
yeah, HR doesn't work on a manufacturing floor.
Okay. So now here comes the really tricky one. Okay. So hourly pay for a finished goods warehouse manager.
Ah,
And for finished goods, once I have somebody that's handling it, after it's complete,
hmm
you might remember over here. So based on that, what do you think? Is it product or period cost?
it would have to be period. Even
Oh,
though
okay.
even though we're talking about the goods like Professor West said, the goods have been completed. They're finished. So there's no longer in manufacturing process. That's going to have to be a period cost.
Okay. Because it sounds like it's going to be a product cost because it's talking about warehouses and finished goods, and it sounds
Yeah,
product like,
yeah.
but don't let that fool you because it's afterwards. All right, let's go look at some fixed costs, okay? So here's some classic terms. So Eric, what do you think? You want to ask me about these, see if I can get them right this
Sure,
time.
sure. The depreciation on the factory equipment. So you're going to see depreciation, and depreciation always is going to have a last name to tell you exactly what it's depreciating.
Yeah,
So
that's right.
yeah, so depreciation of factory equipment. What do you think that's going to be? Product or period?
Since you've got the F word in here, factory, I'm going to go with product.
Exactly, exactly. Anytime you see, factory, manufacturing, plant, anything like that, that's going to be a product.
Got it.
Now, the last name for number two is salesperson cars, for depreciation for the salesperson cars.
That's got to be a period cost because that's outside of actually making the product. Okay.
Happens after the manufacturing process, exactly. So the salary of the factory supervisor, remember that whenever you see salary, you know that that's going to be a fixed cost. That's why it's in this group of categories.
Okay, great.
And we have a factory supervisor. Well, he's not really making anything. Is that going to be a product or period?
Oh, this is a tricky one, right? Because we know that it's going to be a product cost because we saw the word factory or manufacturing. And so this was going to be a classic setup for overhead, right? So this is going to be an overhead piece.
Absolutely, absolutely. It is a manufacturing cost that's not direct material, direct labor. Boom.
Boom.
Has to be
That's
product, has to be overhead. Exactly.
that's the Valentine rule. If it has to do with the factory, but it's not material or labor, you know it's overhead. Okay. Factory maintenance,
Of the monthly
same
fee.
kind, same kind of idea, right? So
Yep.
that one's a product cost. Uh, let's see. Oops. Just to see if I was paying attention, I put the same thing in here twice. Okay. And then there's the mistake one. So if you're keeping track, mistake one of the day. All right. And then this last one, tell me a little bit about this last one.
Well, you have the salary of the factory. Okay,
The
my
chief
bad.
financial officer.
Yeah, the chief financial salary of the chief financial officer. So it is salary.
Yep. So we know
So
it's
what are you going?
fixed.
Yep, and
But that
financial.
chief financial officer, I'm betting money is not out there actually producing the product. And so they're probably over here in the period world.
Yeah,
Okay.
not many CFOs I know are getting too dirty.
Yeah.
So
When I was a CFO, we had a job shift or job exchange program. So I had to go out to the shop floor and actually run one of the manufacturing machines. Uh, I was very dangerous. They had to watch me very, very closely. All right, now we've got a bunch of other costs that are, I don't know what they are. So are they variable or fixed? Do we know if they're product or period? And so you want to ask me about these, Eric?
Yeah, yeah. How about how would you classify utilities? You just get a utility bill. Where are you going to put that?
Well, if I think about it, like this is my facility.
Mm-hmm.
So this is my facility, and I've got an office over here. Offices are over here, and the factory is over here. Well, if I'm paying utilities in total, a part of it is with the office, a part of it is for the factory. So in this case, they're a little of both.
Yep.
And the other part that's difficult is that some of those utilities may be variable depending on how much power I use, how many kilowatt hours I use, and then some of it might be fixed because there's just a charge to be hooked up to the to the electric grid. So that's an interesting challenge. So to get this one straightened out, you need more information. So everything down in this category, you're going to need more information. So insurance, same kind of idea. Property taxes, again, same kind of idea. Oh, here's a couple of other ones. There's a depreciation one. But what's the difference between the depreciation that you have here, that's for the facility, and the depreciation you had up here, which was for the factory equipment or the salesperson cars?
It's using the same logic that you use for the utilities. The facility is going to have a portion that's going to be general administrative overhead, and it's going to have a portion that's going to be manufacturing overhead. So we need to, we need to be able to differentiate which portion is being accounted for.
Yeah, so the last name on this one, like Eric said, is facility. That's not enough information in that last name to be able to tell us whether it deals with the factory or it's a period cost. Same thing here. The facility mortgage, that's an overall amount. The interest is paid. How does that get allocated? And now this is one of Eric's favorites right here. So you can talk about this one, because this was on one of Eric's previous exams. He said, okay, here's total payroll. Is that a product cost or a period cost? And is it variable or fixed?
Yes.
Okay.
Yeah, because total payroll encompasses everything.
Okay, so if this is total payroll, and I've got some people that are working in the factory, they're going to be product costs. Some people that aren't. I'll have some people that are hourly and some people that are salary. And so I can have payroll in any of the four quadrants. So again, you'd have to have more information to solve the problem.
Yep.
Okay. Anything else you want to highlight there, Eric?
No, I'm good. I think
Okay.
think that's pretty concise.
Okay. So then we're going to go over to problem 2. You got to stick with this because this one is really, really important. And it also highlights for you this whole idea of cost behavior, because when we teach executive MBAs, they get this problem wrong all the time. And so one of the things you want to think about here is how do these costs behave at two different levels when you're thinking about a total cost and you're thinking about an average cost. So that's what we need to talk about. That's what we need to talk about. And this is all built around that equation that we had early, which is y is equal to mx plus b. Eric, tell us again what the alphabet tells us.
So Y is your total cost.
Okay,
That's
so
your
that's total cost.
mhm.
Okay, great.
And M is your variable rate or your variable cost per unit.
Per unit. And that's the key. It's the per unit amount or the slope of the line. The slope
Correct.
of the line.
Yeah, because I'm sure you've seen this in econ
Oh.
before. I'm sure you've seen this econ and finance before. So this equation shouldn't be new to you.
No.
X is your volume.
Okay, so that's the volume. And this one?
And B is your fixed cost.
So this is fixed in total.
Correct.
Okay. And so one of the things that you know, the two constants, write this down, the two constants in the equation are going to be the M and the B.
Mm-hmm.
Okay. Those are going to be constant. The thing that changes is the X. And because it changes, it's going to have an impact on this total cost.
Right.
Okay. And so that's the setup that we've got as we head into this little problem. And I must confess, this is one of my favorite kinds of little problems. Okay. So that's what we're going to look at. So here's a situation where we've got volume of 10,000 units, 15,000 units, and 21. Remember, that's the X. The volume is the X. Now, what else do I know? Well, I know that my total variable costs are 20,000. So my total variable costs are MX. That piece is total variable.
Mm-hmm.
So if I know that, what's the next thing I can compute, Eric?
You can compute your, if I were doing this problem, the first thing I would do, well, I guess I'm doing the same thing. I would say you can compute your total variable cost for 15,000, but in order to do that, you'd have to determine what the M is. So I kind of skipped that step in my head.
Yeah, so if I'm going to get the M, I've got to take the 20,000 divided by the 10, and that tells me that this is going to be 2. So
Yep.
I know the M has to be 2. Now, you'll also notice that when we set up our spreadsheets for this kind of discussion, you already have the answers because we make them in light gray on your sheets. That's one. The reason is basically so we don't make as many mistakes as we normally do. We want the answers, but hopefully this also gives you a chance to practice and then see right away what the answer is going to be. So if I know this 2, if I know M is 2, what will it be, Eric, then at these different volumes?
Because the variable cost per unit does not change, it's going to be the same.
Okay, so that's a real key factor here. The M doesn't change. It's constant. So when you're working this type of problem, you're always trying to solve for the M and the B, because once you know those two, you've got your equation put together.
Exactly.
You've got your equation put together. So Eric, then take us down this total variable cost that you were taking us down just a minute ago. How am I going to get these numbers?
Okay, so now that you know that your variable expenses are $2 per unit, at the 15,000 level, it's 15,000 volume level, you know, your variable cost would have to be 15,000 times 2, $30,000.
Okay.
And similarly, for 21,000, it have to be 21,000 times 2, or 42,000.
Cool. So I've got 42,000, 30,000, and 20. Now, this is where you have to be a little careful, right? Because variable costs per unit, they're constant. But in total, they go up or down depending on what volume does.
Yes.
So just like you were talking about at one point, the idea of TV and renting movies.
Yes.
You know,
Yeah.
if the more of that I do for $2 a pop, the more I'll either have, or if I have to cut back, then I can reduce my total variable cost that way.
It's up to you. I have this conversation a lot with my wife regarding cigars.
Oh, well, I have the same conversation over bourbon. So between us, we can make this happen. All right.
Yeah.
So once I know the variable costs of 30, and I know this total cost is 72, I can get this fixed cost, right?
It has to be, yes, has to be 42,000 because
Okay.
your total cost, remember the equation, y equals ax plus b. So we've determined what ax is. We were given y, and so the b would have to be 42.
So the MX, as he points out, was the 30. So the B has to be the 42. And so
Exactly.
once he knows that 42, that's also constant. And you'll hear us call them constant, not fixed. Okay? Because fixed has a very specific terminology that goes behind it, just like the variable cost per unit. But remember, those two pieces, the M and the B, are constant. They're always constant. All right? So at that point, we can kind of fill out the rest. And you'll notice that as volume goes up, total cost also goes up. And as Eric pointed out, the only reason that occurs is because of MX, because the B doesn't change. The only reason this total cost goes up is because our total variable costs are going up. However, it's just the opposite when you're looking at the average costs. So take us through that one, Eric, because that one tends to throw my exec MBAs off.
Yeah. Now, what is average? Average is just your total over your activity. And
So I
so
take the 72. I would take the 72,000 that we were looking at before, divide it by the 15,000, and that gives me this $4.80. So that's my total average cost over all of the stuff that I made.
yeah. So, if we have our total cost, then how much does it cost on average to produce one widget? And so because our volume is increasing, our total average cost, our total cost is increasing as well, but our total average cost is going down.
Because you're just increasing this number, and this fixed cost component of it has remained the same.
That is the driver, exactly. Because the variable cost, of course, is going to be increased by your changes in volume, but the fixed cost is going to be constant. And so it's like the analogy I gave you earlier. You have a one bedroom apartment. You're by yourself. You're paying $1,000. You get two people in there. You're paying $500 a piece. 4 people. That'd be pretty crowded one bedroom apartment. But that'd be $250 a piece. So the more volume you have under a constant cost, the lower your average cost is going to be.
And at the end of the semester, you might want 99 additional roommates. So you've got 100 people. Now you're only paying $10 a piece. You have to time share the shower, some other things, like Eric says, some inconvenience. But I can drive down artificially that cost per person because I've just increased the denominator.
And
so
worth every penny of savings.
Yeah, that's right. That's right, especially at the end of the semester. All right, so those are the highlights that we have in this cost behavior discussion. You've got some problems to follow up on in homework that you can deal with here, but that is the first component of Module 2, and we'll see you back here. Anything else, Eric?
I think that's good. I think we're good.
All right. Talk to you later.
All right. Bye.